In Washington, D.C., this is The Economist. I'm Zanny Minton-Beddoes, economics editor. The Federal Reserve, perhaps the world's most important central bank, celebrates its centenary this year. 100 years ago, America's central bank was founded. With me to discuss what this first century looked like and what the next few years might have is Greg Ip, our US economics editor. I was struck when I read your fascinating article on the Fed's first century, how similar the circumstances were 100 years ago to today in many ways. There'd been a huge financial crisis and the central bank was created from that. Give us a sense of the debates of the time and the birth of the Federal Reserve.
You're right, Zanny. The resemblance between the current period and when the Fed was created is really quite striking. Think about it. For the first century of its existence, Americans had this inbred suspicion of centralized financial power. They chartered two de facto central banks and let them both lapse because of these suspicions. But by 1907, the United States had suffered a series of financial panics originating in the fragile nature of its banking system, and basically Congress concluded the time had come to create a central bank. But exactly what form would that central bank take? And there were enormous fights between those who thought it should be run by and controlled by banks and those who thought, no, it should be run by and controlled by Washington. And that very much echoes the concerns you have today. We have once again gone through a devastating financial crisis that has exposed these structural flaws in our financial system, and we continue to have debates about what the right solution is. Is the solution a system that is more supportive and beholden to bankers, or one that is much more in line with the needs of the overall economy? And you see that in some of the debates about whether the Fed today has emerged from this period too strong.
So the Wall Street versus Main Street debate, if you will, has been one that's characterized, I mean, frankly, it's characterized the whole of US history, but it's particularly characterized this first 100 years of the Fed. The Fed's mandate and kind of what it's focused on has shifted a lot during that first 100 years. And it strikes me, just if you look back, there were two huge failures, if you will. There was the 1930s, the Depression, and Ben Bernanke, the current Fed chairman, in fact, basically said as much once. He apologized to Milton Friedman and said, we messed up as central bankers, we won't do it again. The other big failure was really the 1970s, the huge inflationary era. How do you, when you stand back looking over a whole century of what the Fed did, give us a sense of the lessons that the central bank has drawn from those and how they changed the Fed, those two experiences?
It's very interesting because the 1930s was a period when the financial system basically collapsed, and historians who look at this say the problem was that the Fed was still too attached to its original mandate to be a passive assistant to the real economy. It would only lend if banks and their customers wanted the money. It did not perceive itself as having a duty to maintain full employment and therefore proactively force additional liquidity into the system. So the reforms that took place under Franklin Roosevelt changed that presumption, and what took the Fed from being a passive reactor to events to being very much a manager of the overall economy, using open market operations at the direction of people appointed by Congress and the President to ensure that the economy fulfilled its total potential. Now, the next failure in the 70s was actually kind of the opposite, because you come to a period after 40 or 50 years of this more activist philosophy, and the Fed has overstepped its ability by trying to push the economy past its bounds in terms of how low unemployment can get, and inflation as a result. What's interesting is that Congress did not react by shrinking the Fed, but by simply giving it a more clear mandate: stable prices, full employment.
So the dual mandate, it comes from the late 1970s, right? 1978, I believe, that it was introduced, and that formalized the notion that the Fed should focus on both, which makes it different to many central banks internationally. And it raises another question in my mind, because you look back over 100 years of central banking and you realize that, much like fashion, central banking has its modes, there was the gold standard era, lasted longer than most other fashions. But then you had monetarism, you had, the last 20 years you've had inflation targeting. Do you think that we're on the cusp of a new era, or is the era of inflation targeting one that we're going to is going to be with us for the foreseeable future?
I think we are on the cusp of a new era, but we're still not sure what that new era looks like. If you think about it, the Great Moderation, that period from 1982 to 2007, when the Fed managed to keep inflation and unemployment low, and we had only two very mild recessions, the view basically became that the Fed's job was quite simple. One, target 2% inflation, one tool, move the short-term interest rate up and down. The crisis demonstrated just how inadequate that tool and that target have been, and the Fed since then has been trying to discover and operationalize new frameworks, and so it is using many more tools like quantitative easing, the purchase of bonds with newly created money. It has taken on new responsibilities, stability of the entire financial system, not just the banks. And this partly reflects its own inclinations, but also the expectations of society. We want the Fed to do more, in particular because others don't seem capable of doing what the economy needs.
Well, that, I think, leads to a really interesting question of whether, and I think in your piece you say, Paul Volcker says the Fed has got too big for its britches. Has the Fed got too big for its britches, or is it, because it is seen as a credible institution, being expected by society to do more because politicians, frankly, are so useless?
It has definitely gotten bigger, and the jury is still out on whether bigger is better. We won't know until we've been through another decade or so and see how well it performs with these new duties and these new expectations. And you will hear, as you did 100 years ago and 50 years ago, people saying the Fed's too powerful, we need to carve back its mandate, limit its discretion, and so forth. But my read on history is that that is not going to happen. The fact of the matter is that every time this country goes through an economic crisis, the people in power, and this is Democrats and Republicans, they turn to the Fed and they ask it to do more, whether it's crisis fighting or support for the economy. Partly because that for whatever mistakes it may have made, it is still an organization run by smart technocrats who are driven mostly by the desire to do the best thing for the economy, not to get reelected. And when Congress and the President look around, they can't find anybody else better suited to try and do that. Volcker himself admits that notwithstanding this, in his view, regrettable tendency for the Fed to grow after each crisis, there really is no way to pull it back because there's no other game in town.
So maybe too powerful, but we really don't have an alternative right now. Greg, thank you so much. It's a fascinating piece. I recommend you read it. In Washington, D.C., this is The Economist.
The Economist.